Thank you so much. Welcome to Financial Literacy, Part 1, and let's get started. Today's agenda, we're going to focus specifically on the income statement. Part 2 will include the balance sheet and the cash flow statement. Now, why should this talk interest you? Well, frankly speaking, finance is the language of business. Of course, you can go to Italy without speaking Italian, but it's much better if you do. And the same goes with whatever job you have in business. In order to assess the quality of your impact, you have to be able to speak the language of business. And that language is finance. Now, finance really is the bookend of strategy. Finance is how we pay for the execution of the strategy, and then after completing the strategy, finance again is how we measure the success or failure of that strategy. Again, finance is the bookend of strategy. How do we pay for the strategy? And then upon execution of the strategy, how do we measure its impact? Now, I'd like you to think of an income statement analogous to a movie clip as a length of time. Often an income statement might have a period of time spanning from January 1st to March 31st. Now, at the end of the day, your CEO mainly cares about two things. She cares about increasing revenue and decreasing cost. In fact, if you look at the upper right illustration, the simple equation for profitability is all of the revenue minus all of the costs. Now let's talk briefly about GAAP, because not every income statement among different companies will look the same. Financial documents are based on the generally accepted accounting principles, or GAAP, and this is a set of common standards and procedures used in developing financial statements. It's only a set of standards, so there is room for firms to compile financial documents with some variance. No two income statements among differing companies will look exactly the same. Now again, the income statement is analogous to a video clip, not a snapshot. And it is also known as the P&L statement, profit and loss statement, or the statement of revenue and expenses. So the financial statement really summarizes the revenues and costs incurred during a specific time. Now, revenue refers to all the money coming into the company that the customers pay against all of the money leaving the company, money out in the expenses that the company incurred trying to generate that revenue. Now, in a nutshell, again, your CEO cares about two things: increasing revenue, decreasing cost. If we really had to talk about the essence of business, in fact, it would boil down to this. Now, if I had to teach finance in just one slide, this may be that slide. The income statement is really about revenue minus all of the costs. And the value added is how a firm increases its market capitalization. So I want you to pay attention to the colors. We have the green minus the red equals net income. Net income also refers to profitability. Now this is a standard typical income statement, and we could see that the total revenue is approximately $73 million. And then when we get to the bottom of the income statement, we're left with about $7.7 million in net income. So I want you to look at that one line, total income $73 million, and then every other line on that income statement really refers to the costs and expenses that reduces that original $70 million revenue number. Now again, we're going to refer back to the colors on this slide, and we will reiterate. Green minus red, revenue minus all of the cost, equals net income or profitability. So when we return to our original income statement that we saw in the previous slide, we're looking at the same colors. Again, green minus red equals the net income. This is the true essence of any income statement. Now, the analogy that we use is that an income statement can be thought of as an ice cream cone, and we're referring to the shape of the cone. Now, an income statement is very asymmetrical in the type of information it delivers. Essentially, the income statement is about one line talking about all of the money coming into the company, while every other line on the income statement talks about all of the expenses leaving the money. Again, one line is about the inflow and every other line in the income statement is about the outflow of money. So generally speaking, an income statement starts off with its largest number on top, revenue, with every other line, costs, reducing that top line number as the cone narrows with each additional line. And this illustration will really help us visualize how an income statement is asymmetrical in the type of information it delivers. We have sales on top, one line, with every other line reducing that revenue number on top until we have net income on the bottom. Please note that revenue is often referred to as top line or top line revenue because of its position on the income statement, and net income is frequently referred to as the bottom line, referring again to its position at the bottom of the income statement. Now, an income statement segments costs into two general categories. We have all of the direct costs, referred to as COGS, or cost of goods sold, and then we have the indirect costs, which are usually under SG&A, selling, general, and administration. Now again, to reiterate, there are only two ways to make a dollar: increase revenue by $1 or decrease cost by $1. Both will improve net income by that $1. Now, COGS is referred to as different names depending on the type of sector of the economy the business is in. In a manufacturing economy, it's often referred to as cost of goods sold. In the service economy, cost of sales. And in the knowledge economy, it is often referred to as cost of revenue. But it all refers to the same thing, the direct costs. And then we have the SG&A costs, which refer to the indirect costs, meaning costs that are not directly tied to the product or service being sold. It's also referred to as SG&A and sometimes G&A. Now, a very simple illustration. If our company makes a mousetrap, the COGS, the direct costs, refer to the cost of the block of wood, the cost of the metal spring, and the direct labor cost for the mousetrap. Some of the indirect costs, SG&A, might refer to company cars, office supplies, marketing, and perhaps the CEO's salary, the IT salary, the salary of any employee that works in support, not in direct assembly, but in support of selling that mousetrap. Now, a financial ratio allows us to look at two numbers as one metric, and that's why financial ratio could be so powerful. Now, if we look at our income statement, we already talked about revenue, and we talked about COGS, cost of goods sold, the direct costs. Well, if we take revenue and we subtract COGS, we are left with a type of profit, the gross profit. And then if we take that gross profit and we divide it by revenue, we now have a gross margin. So we've gone from gross profit, which is given in an absolute dollar amount, to a gross margin, which is given as a percentage. Our next journey along the income statement is now, instead of just subtracting COGS from revenue, we are extending the equation by now subtracting SG&A in addition to COGS from revenue, and we are left with another type of income or profit called operating income. And then, analogous to the example in our previous slide, if we now take operating income and we divide by that same revenue line as the denominator, we now have an operating margin. So we've gone from operating income, which is given in an absolute dollar amount, to an operating margin, which is given as a percentage. And now, if we continue our walk down the income statement and we subtract all other expenses, we are left with net income. And again, if we make net income our numerator and we make revenue our denominator, we are now left with the ultimate margin called the profit margin. And arguably, this might be the most important margin that companies refer to because it encompasses everything. So again, if we take revenue minus all of the costs, we're left with profitability or net income. And if we take that net income and make it the numerator and continue to have revenue as our denominator, we now have the profit margin. Now I'm going to reiterate, because the profit margin really is considered one of the most important margins for a company. Again, it's simply net income divided by revenue, and we always have the bottom line as the top line numerator and top line revenue as the denominator. So that might be a good way to remember it, that it almost reverses position. Now again, continuing with our analogy that an income statement is like an ice cream cone, we talked about how the revenue number constantly narrows until we get to the bottom line. Well, analogous to that, we could imagine that the gross margin, the operating margin, the profit margin will always, as a percentage, decrease in size. And it makes sense, because the gross margin is only backing out the COGS, whereas the operating margin is backing out the COGS and the SG&A costs, and then the actual net income backs out all of the costs in totality. So it would make sense that the gross margin and the operating margin and the profit margin will be decreasing in size as a percentage. And here we simply illustrate the same concept, but on your own you could work out the numbers, and we see that on the example that we gave of our income statement, the gross margin is 67%, the operating margin 40%, and our profit margin 33%. And this makes sense because the nominator is always decreasing, while the denominator, revenue, is always going to remain constant. Now we see from this example that we've blown up the lines in blue. Revenue is $100,000, gross margin is $40,000, operating income is $30,000, and then net income is $15,000 on the bottom. So again, we're illustrating how the numbers from the largest number, top line revenue, continue to narrow, and this is why we could visualize the income statement as an ice cream cone with net income at the bottom of that cone at its most narrow position. Now again, income statements are very asymmetrical in the categories of information. Usually one line talks about the money coming in, while every other line lists different categories where money is going out. Here we've used the same numbers, and we've taken the absolute dollar amounts, and we have described them as their counterparts in margins. 40% to 30% to 15%. From gross operating to profit margin, all of the margins decrease again as the cone narrows in our illustration. Now, if you go back to a webinar we gave on February 25th, and it is archived if you are interested, we talked about a new strategic cube method. And in that webinar, we really talked about how could you measure a company's strategic drift. And in that lecture, in that webinar, we really introduced a cube where we talked about how every company has at least 6 dimensions of strategy. Now, if you take today's webinar and you integrate it with the webinar we gave on February 25th, which again is archived, we could see how we could reverse engineer the information we found on the income statement and reverse engineer those financials to infer the strategy of either your own company, if you want to see if there's any drift between your intended and espoused mission statement and what actually happened, or even perhaps looking at a competitor if they happen to be a public company with their financials easily accessible. So it is beyond the scope of this webinar to go into everything in detail, but if you are interested, you could revisit the February 25th webinar and look at the dimensions of the cube and how you could infer a competitor's strategy just by reverse engineering the financials. In fact, it's a wonderful way to prepare for an interview. If you're being interviewed by a public company, grab their financials off the internet and try to infer their strategy from the financials. Now, why don't income statements provide even more detail, especially since most companies have multiple revenue streams? Well, going back to the beginning of our webinar, we said that finance is the bookend of strategy. How are you going to pay for the strategy, and then how you're going to measure the success of that strategy. Because of that, it's very easy for people like you and I to reverse engineer financial documents and figure out a competitor's strategy. And that is why, as a public document, companies want to reveal the least amount of information that they are legally required to reveal to the public. Again, it's because people who understand finance can reverse engineer financial documents to discover a competitor's strategy. Now here's a bonus tip, a common size income statement. It's simply an income statement expressed not in dollar amounts, but as percentages. You take each line of the income statement and you divide it by revenue. Each line is expressed as its percentage divided by revenue. And this is a wonderful way to compare two different companies of different sizes, or perhaps the same company along different periods of time as it may have grown or as it may have shrunk, but you can at least normalize the data and do a more rigorous analysis of its income statement over time. Our non sequitur of the day, don't be cool. Cool is conservative fear dressed in black. I hope you enjoyed today's webinar. Please join us on June 30th for part 2, where we will look at the balance sheet and the cash flow statement. Thank you for joining me today.